conversation tends to be around access and access to bank accounts. And there are 7% of US households today that are considered unbanked, and that's about 9 million Americans. And there are interesting startups helping bank that population. B was a part of the FinLab's first class, and I know Fenway is an investor in them as well. And they're providing a mobile-first alternative to a banking or to a checking and savings account. And they're actually operating like pop-up shops in underserved neighborhoods in both the Bronx and in Oakland, California, and trying to find new ways of reaching underserved consumers. But the reality of it is that 93% of Americans have a bank account today. So it becomes not just access, but better financial products that are helping people manage their financial lives. And while 93% of Americans have a bank account, CFSI finds that over half of Americans are financially struggling. And so I think part of the opportunity is really reframing the challenge, that it's not even just about the un- and underbanked today, it's about Americans in general and Americans' financial health in general.
The challenge at Climb that we're trying to solve is the skills gap. So there's a number of different reasons why someone might be part of the 99%, which is actually basically everybody, but it's huge. But especially in this country, one of the reasons why someone might be living, at or below the poverty line is not necessarily because they don't have a bank account or they don't have access, but is because they literally aren't making enough money to pay the bare minimum bills that they need to pay in order to eat and clothe their family and live wherever they live. And so there's a number of ways to get out of that cycle, but one of them is to learn the skills that you need to have in order to make a higher wage job. And one of the challenges that we see, there's a number of challenges in doing that, but one of the challenges we see is that people want to do that, but they can't find financing. And the reason that they can't find financing is because they are low income, right? That means they've had challenges in terms of maintaining a positive credit report and having kind of the attributes that traditional lenders require in order to give a loan. One thing Climb is working to do is to create solutions for people who may be considered more mid or subprime, but are making that active effort to learn the skills that they need to learn in order to get a higher paying job.
We believe that technology is really the great equalizer, if you will, and we've really anchored the development of our technology that will deliver to all customers in artificial intelligence. We recently made an acquisition of a nonlinear regressive technology that now we're implementing into our technology and giving that technology and putting it into the hands of the consumers, right? Our ultimate goal, and I've been an entrepreneur for some time. I've built some successful companies in the past, and I've seen the highs and the lows and so on and so forth. But so I understand economic strains, and maybe my wife understands that better than I do. But in any case, the goal for us was to build a technology that would unlock the financial power of the middle class, and so delivering the most powerful AI, based technology to consumers where we can better help them with their finances. And I think our ultimate goal is expanding someone's personal portfolio. It's interesting, I live in Newport Beach, California. It's there are a lot of entrepreneurs, a lot of wealth there, but if you went inland just a little bit and you talk about someone's personal portfolio, that doesn't exist. They don't know what I'm talking about. So I believe that delivering the right technology, and that's what we're working on, and the goal for us is to deliver that technology working with the banks. You see a lot of FinTech out trying to compete with and so on and so forth. It's a difficult road, and we do enable some of the alternative lenders out there as well, but the goal for us is to take that customer base and improve upon it and helping them to identify new customers. One project that we're working on is that for one particular bank that we're working with, 50 million people apply for credit and 25 million people are turned down. And so we're now delivering that technology to those 25 million to help educate them, which we talked about a little bit. Education is one, delivering very powerful tools to them so they can self-teach, with the ultimate goal is getting them approved for that loan, but changing their behavior, which is a big deal, is changing their financial behavior under education and tools and so forth, ultimately helping them to become better financial citizens, if that makes sense.
Talk about a little bit about the actual premise you use as you're looking at an investment, the thesis you use, because you got to hit some hurdle rates and you got to give back money to investors, hopefully with a return. So talk a little bit about when you think about financial inclusion as an investing opportunity, like what are you looking for? What works, what doesn't work, specifically in emerging markets?
I'm really glad you asked. That we're on a mission to redefine impact investing. In fact, you heard when I introduced Quona, I said a venture firm that does FinTech for the unbanked. Because when people hear impact investing, they say sanctimonious, like holier than thou, someone coming from on high telling you what you should do, and or soft, meaning that we don't care about return. Our investors are insurance companies, investment banks, JP Morgan, Goldman Sachs. We have pension funds, university endowments. There is no way they invested in us with the goal of a concessionary return. We have to deliver a risk-adjusted return. But we do so, and so to answer your question, we are driven by a mission. We believe in profits with purpose. And the way we do that is by, one, starting with the premise that we only invest in companies that are radically changing how the financial system works and making it work for the many, not just for the few. And so that's what all of us are doing. And so, and again, I think all of us approach this with a rigor around you don't have to be soft, you don't have to be concessionary, you just have to do things the right way and focus on people who have been ignored. And if you focus on people who have been ignored, that's an enormous market. As we see with the political trends that are happening, it's a huge market. So we very much believe that if you, again, it's like old-fashioned private equity. It's not about financial engineering or flipping companies, it's about building real value. It's aligning values with value creation. And there's an enormous opportunity once you start doing that. You don't have to dig very far. And yes, we do report on metrics, so how we measure. We also, to call yourself an impact investor, you have to measure and hold yourself accountable to them, and we do. So we hold ourselves accountable to our IRR and cash-on-cash return, as well as on the social, and we measure social very much the way my colleagues have mentioned. Access, how many people are we serving that have been previously underserved? Quality, what kind, so it's not just counting numbers, but how much does it cost? How convenient is it? What's your NPS score? So we measure lots of ways we think about quality. And then markets. Are we bringing in other competitors? So we actually spend time in Graycroft's office and in Andreessen Horowitz, and actually because for us success is when they show up.
How do you think about building a business that pursues kind of these very lofty ambitions and goals with making money?
Right. So a very smart person who I worked with at Orchard actually once said, it's not hard to come up with a vision, right? It's not hard to know where I want to be in 5 years. What's hard is to figure out how to get there, because you're constantly balancing two things, which is, am I going in the right direction? But am I also still like around? Because you could be going in the right direction to get to that goal, but if that doesn't get you money in the door, or whatever you need to keep operating, that's a challenge. And so what has worked for us at Climb is starting with markets that are a little bit easier to serve, right? So the first type of schools that we worked with were the coding boot camps, right? They were a wide open space. They have no Title IV financing, so there was no government loans going in there. There weren't really any other financing options, so going there was relatively easy as it relates to competition and the credit quality of the people there and all that. And so for us, it was build a business around that. Then you build your infrastructure and you build your processes. You figure out how, in our case, to be a lender, right? Which is, as you brought up, the state-by-state regulation. I mean, I'm regulated in every state. So all that. And then you start to take that infrastructure that you've built, right, and the efficiencies that you've been able to create, and you start to go to the more challenging markets. And so for us, what that's been is going after now Title IV schools. So there's plenty of these skills-based programs who are offering a good quality education to students who have federal government funding. right? So the students can get a Perkins loan or any of these other types of federal loans. Now that doesn't cover their whole tuition. And the options when you get out of the federal government money are not great, particularly for subprime borrowers. They're not great for the students, and they're definitely not great for the school. And so that's now where our focus is. So it's moving from sort of the area where you know you can make an impact today and figure out the business to, okay, now we're going to go to the hard stuff, but where the problem really exists. And so I think for us right now, it's about figuring out how to compete with that gap. And as we grow and have more, have more traction, it's trying to help convince the schools, I think over the long run, how to best leverage the federal financial dollars that are available.
How do you use these new data constructs you were talking about to make sure you avoid the pitfalls of too easy a credit or pricing it too predatory? The different things where credit can go wrong. Can you talk a little bit about how you think about the new constructs in data to achieve that?
Terrific. I thought you were going to ask me something difficult, Javier.
Nothing difficult.
So when you start talking about GDP, international GDP, et cetera, but we've been working very closely with the CFPB. So, they were put in place because of some of the challenges that happened in 08, 09, and unlike a lot of banks or even fintech companies, they don't reach out to the CFPB. They're like, want to avoid it. In fact, the CFPB said you're one of the first tech companies that's actually reached directly out to us. But we've been working with them very closely to design a technology that's in the best interest of the consumer. So we're not driving them into something that could be a worse situation. And it was one of the reasons why when you talk about the type of influencers that we have in the business, the Macs of the world and the John Scoleys, et cetera, for them it's about a noble cause. And we believe, we've in process of developing, delivering a product where all boats rise, where we can help the banks better match up with the customers better understand the rules of the credit game, because there's rules. And with this technology, we can go out and deliver something powerful to consumers to not only educate them, but start to understand those rules. That even if you make a payment on time every month doesn't mean it's going to represent that on your credit report. So there's the way that things are processed. And I think, me coming from the mobility space into fintech, it was shocking to see how archaic the systems really are. And it was fascinating to me, and things don't move very quickly and so forth. You see a lot of the big banks and even some of the bureaus, et cetera. I won't beat up on them, but you're really seeing new marketing spin and essentially putting lipstick on an old pig, right? Or the same pig, if you will. So there is a huge opportunity.